Hi, my name's Randy Bruns. I am principal with Model Wealth, and this is just going to be a demonstration of sequence of returns risk when you're, which basically means if you're taking a constant amount of withdrawal out of a portfolio whose returns are anything but constant. Let's just see how it plays out in the real world when you do that sort of thing. So I'm going to move myself out of the way here. On the screen, you'll see a bunch of asset classes that might comprise a diversified allocation. U.S. large stocks, U.S. small value stocks, foreign large stocks, foreign small value stocks, emerging market stocks, real estate stocks, U.S. bonds and foreign bonds, and cash. And then there's an additional category of returns. This is inflation. Now you might say, okay, well, what are the benchmarks or measuring sticks that you're using to represent all of these asset classes? They're right here. For the U.S. large cap stock market, it's the S&P 500. For foreign large stocks, it's the MSCI Europe, Australasia, Far East Index. If we go to the U.S. bond market, it's the Bloomberg Barclays U.S. Aggregate Bond Index. If we look at cash, it's really just 1 month U.S. Treasury bills. And then inflation is the U.S. Consumer Price Index. There are other asset classes here, but I don't want to belabor the point. On the screen, you'll see that for each of these asset classes, every single calendar year for the 20-year period between 2000 and 2019, you can see the actual calendar year returns. And then you just see all of them. If we scroll to the far right, you'll see the average annual returns over the 20-year period for each of those asset classes. You can also find the inflation-adjusted average annual return or real average annual returns. And then just for the heck of it, we added one more column that basically shows the purchasing power of $1 20 years later. So for each of these asset classes, it actually rose, except cash actually lost some purchasing power. $1 of cash in the year 2000, by the end of 2019, had fallen to purchasing just 90 cents of that same dollar. You can look here and you can see inflation. So 3.39, 1.55, 2.38. You can see in 2008 during the Great Recession, inflation almost fell to zero. But then one other thing we can do is let's just put 50% in large U.S. stocks as represented by the S&P and 50% in U.S. bonds as represented by the Barclays U.S. Aggregate Bond Index. You get this nice pie chart right here. Now, what are we doing with that? Click here. We'll go over here and we'll see that $1 million. And here's 1 million. You can enter whatever amount you want. You can make it $5,000, but let's just make it $1 million because it'll help make the math make a lot more sense. So here you can see that if you retired January 1st of the year 2000 and you had $1 million, and let's just say you're following the popular 4% rule. And for anyone wondering, the 4% rule is a guideline, but it's a rule of thumb that suggests that you can take your at retirement portfolio value, multiply it times 4%. That becomes the baseline amount that you can withdraw from your portfolio. And then in subsequent years, you would just increase that withdrawal amount by the rate of inflation, and you should have a high degree of confidence by historical measures that your funds will survive like a 30-year retirement. It's not a guarantee, but it's a guideline that you'll hear a lot of retirement planning experts discuss. So you can see here the way this works. Here are the returns of blending a 50-50 mix of the S&P 500 and the Barclays U.S. Aggregate Bond Index. When you do that, you can see if you left everything in the S&P, you'd have lost 9, lost 12, lost 22, went up 29%. If you had half your money in the U.S. bond, or if you had all your money in the U.S. bond market, you'd have been up about 12, up about 8, up about 10, up about 4, up 4. But if you blended those in a 50-50 mix, Now you get a 1.27% return in 2000. You lose about 1.74% of your wealth in 2001. You lose 5.92% in 2002. You get a 16.4% increase in 2003, a 7.61%, and so forth and so on. Also, these asset classes rebalance day one of each year back to whatever your target is. And let's just test this. If we just put 100% in the S&P, now you get the -9, -12, -22. The portfolio is -9, -12, -22. But let's go back to the 50-50 allocation. We go back to the sequence of returns tab. So here's another thing. You'll see inflation on this. It pulls directly from the prior sheet. In the year 2000, inflation was 3.39%. So the way the 4% rule works, again, is you just take whatever your withdrawal rate is to start, or whatever the amount is, and it's 4% of 1 million. There you can see it right there. Subsequent years, you just look at whatever the rate of inflation was, and then you would, here, let's do this. So we'll get a calculator up on the screen. You would take that 40,000, and if inflation was 3.39% that year, you just take the 40,000 and you'd multiply times 1.0339, and the next year you would withdraw 41,356. That's right there. That year there's a 1.55% inflation right here. You would then take that 41,356 and multiply times 1.0155. Now you're up to a $41,997 withdrawal. That's that right there. You can look 20 years later, this $59,716, yes, it's almost $20,000 more, but it's really just the inflation equivalent 20 years later of taking out $40,000. If we added the total withdrawals over the 20-year period, you'd have taken out a little bit more than you originally invested. And then you'd look and you'd say, okay, well, what did the ending portfolio grow to? It would have grown to about $1,041,938, which is growth on paper, but it's actually a loss in purchasing power, because now you're taking out $59,716 from a portfolio that's worth $1,041,000. That's a 6.44% withdrawal. Over the entire 20-year period, you can see that the average annual rate of return, if you didn't have any cash flows in or out, you'd have gotten a 6.04% average annual return. But when you consider in the cash flows in or out, in this case, your internal rate of return was 5.22%. If we do so, we can do one other thing with this worksheet. We can say, well, what if we earn these returns in inverse order? So instead of starting with a 1, losing 1.7, losing 5.92, and then ending with a 12, -2, and a 20, what if we started with a 20, a -2, a negative, or a 12, and then we ended with those two negatives and the 1% positive? All we have to do is we can inverse the returns. And now watch what happens here. Instead of $1 million, it's going to now be 1.6 million. It's the same returns, but earned in reverse order. The same 6.04% average annual return, exclusive of cash flows in or out. But because the timing or the sequence of those returns, you get a higher internal rate of return. So now your portfolio, your $1 million actually grew in purchasing power. And the easiest way to see that is you started out at a 4% withdrawal. That 59,000 is now 3.53% withdrawn. And one other thing, we didn't just inverse the order of the returns. We know inflation has to invert with those. Otherwise, it's not true to the withdrawals. And let's do one more thing. Let's just put everything in the S&P 500 for an extreme example. So now you'll see it's the same returns as the S&P. And let's go to the sequence of returns risk. And I'm going to inverse this back to like looking in the actual order of returns. Here you started with $1 million. You got the same $1,004,807 withdrawals. But here's what happened to a portfolio invested in the S&P 500 over the 20-year period from 2000 to 2020, basically. Your $1 million would have fallen to $363,000. So yes, you got a 6.06% average, but your internal rate of return, when you factor in the sequence of returns, was actually just 2.59%. And when you look at that 4% withdrawal year 20, it's now almost an 18% withdrawal. So watch what happens though. And this is might be like kind of a little bit of a mind blow to a lot of individuals. But what if we just inverted the order of these returns? And we'll invert the order of inflation as well. So watch what happens to this. We're going to just reverse the order here. So now you end with a negative 22, a negative 12, negative 9, but you start with the 20th year return and you earn them backward. Now the $1 million ends up growing to almost $2 million. And the 4% withdrawal falls to a 2.67% withdrawal. Nothing happened to the average investment rate of return. So if you were on the moon for this 20-year period, you got a 6.06% average. But because you're pulling from it, the sequence of how returns play out can have a big impact on your ending wealth. So you get a 7.22% internal rate of return. Now, again, one thing you'll also notice here, we had 1,004,000 pulled out because we were following inflation that direction. When we inverse the rate of inflation, which goes in line with inverting the return or inversing the return, now you ended up only pulling about 966,239 out. But I think one quick point of this is if you can choose to have a crash at the start of retirement or a crash at the end of retirement, you should always put the crash on the end of retirement. And I laugh when I say that because nobody knows what markets will do. So you don't know. And what's the best way to defend against that? Well, first of all, you would want to maximize or optimize your Social Security, but also diversify your investments so that the range of outcomes is a much more narrow rather than focus on concentrated allocations to individual asset classes like the S&P 500 in this example. And that's it. If you have any questions, feel free to call us. But this was really just a demonstration of sequence of returns risk, and hope you guys enjoyed it. Thanks.